Hey guys, good morning. It's Julie. Sunday, so the markets are closed. It's I'm going to point out this book. Somebody recommended it over last week in Twitter world. I'm grateful to that person, and this book is fantastic. The Volatility Edge in Options Trading. Jeff Ogden apparently was an instructor at the New York Institute of Finance, so you would assume that the man knew what he was talking about. And the reason I like this so much is it basically validates everything that I've done. So, of course, I'm going to like it. Um, so, he's saying that the institutional traders rely on the statistical history of price using the standard bell curve. Very simple, right? And that's the optimized volatility selling programs based on these banks and institutional dealers and things. We're not talking about market makers. Market makers are different, right? We're talking about the higher than the market makers. We're talking about the dealer and the large institutional investors like the J.P. Morgan, the that fund, the JHEQX. It's all bell curve related, right? So that's why the Jats PT levels, PT is for profit target. So I don't necessarily advocate that you reverse or reverse to the mean at these levels because they can break and go further. You just have to trade to the target, understand where the target is what I recommend. But I can't tell you where to put a position on or what to do when you get there. I can just tell you where the level is. So you can see here that in the ES, price went to this orange line. That's the 3, and it's by time frame. This is a quarterly level. So this chart is showing 30, 60, 90-day ranges on a daily bar. And this one is the 90-day 3. I've got the charts, excuse me, set up so that they're all similar that you can understand. The orange is the 3, and the twos are either red or green, whether you're above or below the distribution. Red for above, giving that little warning that you're 1, 2, 3. Uh, when you leave the 1, you will often go to the 2, right? So here you can see it stayed inside the distribution, went to the 1, hung out there for several days. This is why I do not advocate telling you to go long or short at these levels. It can literally sit on a day and walk it for days and days, like right here. But when it does break out, then like it went right to the opposite 1, came back inside, so there was that reverse to the mean, but it took 1, 2, 3, 4, 5, 6, 7, 8 days to get there, right? So when you're trading these strategies, you have to understand that the dealer has all the time in the world. They're delta neutral, right? And as long as it's inside the 1s, it's up or down. It's non-directional, basically. I mean, you can get an intermediate trend inside the 1s, but you really get the opportunity comes when you break a higher time frame 1, like a quarterly or a monthly, and then try to get to that quarterly or monthly 2, right? Instead of trying to break a daily 1 to go 1, 2, 3, which is fun and it's profitable. All those zero DTE traders are doing that. But when we know where the bigger time frame is breaking out, that's where wealth, can start creating, because then you've found yourself on some solid support resistance and you're going in the direction that you wanted to trade in the overall market. So these lower 1s are very emblematic of that. So if you're going in a long-term trend, you want to look at the lower 1, and that's why you find so much support resistance. The bears are trying to get to the 2 or the 3, and the bulls are trying to send it back in because they're delta neutral. Um, so you're always, you have to decide what trading strategy you're trying to trade. Are you trading spreads where you're selling premium, above the 3, for instance? And Or are you directionally trading? Do you think that three is going to break and go into tails? Is there another higher time frame? So, like if this was a weekly, is there a monthly one, two, three on top of it? Here we're looking at 90-day levels, so that's pretty much the end of the road, right? So when you see that you're at the 90-day level, then you have a much clearer picture in your mind of what you think the market is going to do given that situation. So you can see here currently we hit the 90-day three. We're back inside the 60 and 30-day one. And the middle of this range, coincidentally, is the 90-day two at 46.6250. Down here, the purple lines, these long purple lines, this is the JHEQX, JP Morgan collar, and this is the long put. The long put's in the middle, short call on top, and short put on bottom. So if it goes below that lower purple line, they're going to lose money, so you know that's never going to happen, right? So you can just, you know, in my mind, that's a very low probability trade. So you want to make money, right? So you want to go with the high probability trades. So you wouldn't want to be betting lower than that purple line. I wouldn't. I mean, I'm not trying to tell you where to put your um, price, but you have to trade your own and do your own due diligence. You know what I mean? So this long put, though, at 45.15 or whatever it was, let me look it up. 45.10 confluences with the monthly one at 45.1150. So this is a 30-day one at 45.1150. So because of that confluence, that long put, that 30-day one, remember what we just discussed, if you have a long-term bullish bias, you're going to be looking hard at those lower ones or the boxes starting to check for you. So you can see that there is like a bullseye target on that, right? You've got a confluence, so it's a stronger level. If you were to find, volume or something like that, or a support resistance level where you see that the market had a big bull bar here, breaking it up, and did it, come back and it has not tested it. It broke through it with this big bull bar here. It broke it twice. Now we had a big bull bar breaking through the level. So it, if they get through this zone here at 4600 where everybody's got their puts, you know, 4500 looks like the logical target for that JHEQX. But you have the 60 and 90-day ones right below it. So there's our secret edge. 44.78, 44.41, 25. So you may not see that bounce. You may see that long put gets challenged. And it doesn't matter to JP Morgan because their clients are not losing money. That's what they paid for. They're covered in here. In fact, they don't care. Remember what I said? It's inside the ones basically. To them, it does not matter if price is going long or short. So just be aware of that. Those are delta neutral positions. You just want to be aware that they lose money when it breaks that short call going long, like it did in December, except for they don't actually lose money. It's hedged. The hedge is hedged, so they're okay. Don't worry about them. And I think that's one of the things a market maker sort of gave me a little bit of mentoring there for a brief week once, and that was the one thing that I was impressed upon. Quit focusing on their levels. They know how to take care of themselves. We should focus on what's before us with these, opportunities when they come up. And there's different ways that we can, do that, and that's through the statistical analysis of the historical volatility levels, like the large institutional traders are trading, and then there is, the implied volatility levels, and that's the world that most of the traders on Twitter live in. They're, trading the volume on a day-to-day basis now. Let's see what the open interest is for Monday. They're trading, the opportunities where your high puts and calls are located. Um, and as the morning progresses, these levels change as well as our spread analysis. So you have to be aware of your spread analysis given throughout the day period and realize that the market makers are going to be trading at this mechanism. If you're above the future price, you're going towards your straddle on the right. If you're trading below the future price, the mean, you're going to the straddle on the left. And then using your delta and your open interest volume to guide you. The delta that, they have their favorite numbers, and that delta can be positioned around the bell curve. So you can see the 25 put delta is at 47.15, the 25 call delta is at 47.55, and then you can see your range, the implied volatility from 1 to 2 and from 2 to 3. And so this 5 deltas down here in the 3 for the implied vol, and that's a very low probability trade. That's why you see this 47.75 call. So that when you're looking at these volumes on your bell curve from the implied vol that Quick Strike shows us, because they're institutional traders, they're probably selling premium, right? They're not buying. So you would be looking at these as, bounce opportunities potentially, right? Or you trade to target. I don't know how you trade. People have very different strategies. Some are hedging, you know, some are directionally trading, and some trade condors or, call spreads. We don't know what everybody else trades. Um, and you have futures traders, so that are directionally targeted traders, whether they're option traders or futures traders. You forget there's futures traders out there. In fact, the majority of the market is directionally futures, hedging stocks or option positions. So here is a Monday's Black Scholes bell curve on Quick Strike. And so you can come to Quick Strike and set these up. Here is the calcs on the settlement. And you can see your high gamma is at 47.35, which is the mean. So I like to mark the chart with that, as well as my at the money, in the money, out of the money. So at the money for Monday's 47.20 to 47.50, and then this little in the money period 47.50 to 47.70, or conversely 47.15 through 4700, and then you go out of the money. So then we're really, leaving the implied volatility distribution, heading out, and you can see the corresponding delta levels. And this is what people will trade. They will trade their favorite deltas, maybe 10 deltas for, condors and things like that. And you're leaning on these in the money, out of the money levels for probabilities. So know where you are on the distribution, know what the next month is doing. So, if we look at the end of January to see where we are going to be just for this coming month, we can put it, the difference between black and Black Scholes is black is really for current futures trading. And just the BSM is what a lot of the institutional investors use. So I like the BSM also. And I run my calcs on the settlement to get, these deviation levels that they might be looking at. So 4730 is the mean. And we can see here the gamma, the high gamma is at, here's 284, 4780 to 4760 to 4750. So you can mark your charts using this, and then you want to see where the high volume is for the end of the month, where those high volume puts and calls. So here's the end of the month, open interest, and you can see the puts are stacking. And here's the big put just under that 15 delta at 45.50. 47.34 to 75 is the mean. So if you would like to, mark your chart using the implied volatility levels and then recognize your volatility curve as your volatility rises, you're going to be going into these puts. And so you might expect to see a little bit of, fights at these levels where the bulls and bears try to come in to the market there. So just by focusing on these, option levels that you know that there's going to be plenty of market participants participating, and whether your volatility is going long or short is going to help you tremendously, set up your intraday positions. And in addition to having the implied volatility, when you can marry that with the historic volatility and understand where you are on a day-to-day time frame, that's where you can really start, making progress. Um, Let me show you some extra charts. The weekly three and the daily, 30-day 1, 2, 3 on this chart with the JHEQX. Here's your long put and your short call, and short put, long put, short call. So you can see we're at the end of the 7-day weekly threes, and that held the week because that's, there's your spread for the week. It ran into the spread week, the threes. So I think that we might, see the bounce in the early part of the week because we're sitting on the lower ones, but be aware that at some point these ranges can break, and then they would be running to either the three or that, here's your long put and your 30-day three. Here's your 60-day three. So there's a 1 and 2 month encapsulating your 7-day and weekly threes. So that can give you a huge help to know where the higher time frame might be positioning. And if Herkster is watching this, you can see we were wading through this pain of our 30-day three sitting right there. Price got on top of it and just sort of walked the line for over a week. And finally was able to break out. And here we are almost coming back into this huge volume zone. And there's that 4600. So if you go back and look at your implied volatility level, you'll see here's that big 4600 put, and it's at the first standard deviation of that range, that implied volatility range. So that's going to be, that magnet for a lot of the institutional traders. Whether that occurs, sooner or later, we have to the end of the month to get there, right? So just be monitoring your daily chart, and the market adheres to these daily ranges, intraday. Sometimes they'll break out. Um, that's okay. We have tails. So um, there's two distributions here. I've got an ability to calculate the levels using the open or the close. I can't tell you how we do our calcs, but they are a different calculation for a daily range. And I only display the ones from the open in the market analyzer and Substack. If you would, I'll show charts with both of them on, but the market analyzer uses the open, which is the middle of the range. Calcs on the close are different, and you can see they often will act as support resistance intraday. So getting back to what I was saying about having tails, the beauty with Jats is we're able to extend the distribution beyond the range. So it doesn't matter if they break a daily range. Ranges are meant to be broken. They're meant to be respected, and they are respected a lot, but sometimes they break due to factors like OPEX or expiration or a bad, headline. And then you can project outside the range, um, where targets are, either to trade or to use to lean on for your risk. And that you would be able to, examine that. I do. I've shown this 100 times. Use a measured range versus a Fibonacci number. Anything that you use, you want to, see what are you trying to do. Are you trying to hedge, or are you trying to hit a line? If you're trying to hit a line, you want to set up your pivot points or your PT levels that are easily obtainable. And that's easy to do with Jats. If you get it for NinjaTrader, you can set these up on an hourly or half hour basis and really know where those one, two, threes are likely to go with probability. So here, going from the mean to the three, we can measure down, and you can see here's your first target, your first tail. So it's just a measurement. And then you can, see that I duplicate this same range for my tails going out, measured moves. But you could set it up closer if you would like. You can actually, change it to whatever you want it to be. So if you wanted to use a fib number or a larger setting, you could do that. And interestingly, you can extend these from the 1, 2, or 3. So if you wanted to run tails outside the PT1 instead of the PT3, you can do that. And that can provide some interesting levels to trade to. Or you can extend them out from the 2. So you have the ability to put tails outside the 1, 2, or 3. By just add another instance to the chart and run it from the other instance, and then you would have all your bases covered. You'd have plenty of levels to trade to have targets reached for your algos. So, whether you're having a higher time frame in mind, when we get near the quarterly end of the quarter, like end of December and things like that, that's when these quarterly ranges really come into play. That 90-day, came into play at the end of the year because, That's when you look at these ranges. It went all the way to the quarterly three. And that's where the market was trying to go higher. And I was like laughing because, they'd already broken the JHEQX, and that was the end of the hedge. The hedge's hedge ended there. I saw it, and I thought it was brilliant. Okay, so we looked at our monthly. You can do this on the weekly range by using the days of the week or the trade session days in the week. And there is an art to setting the number of days that you use in your calcs, and that's an advanced workshop. And we can go over that in training for those of you who get the indicator for NinjaTrader. I can show you how to set that up um, using the days in your calculations to get some of these finer tuned, um, quantifiable, be a quant, get the levels set up with a higher precision. Here is the quarterly three, and you can see we hit the quarterly three, but I've got 3 month, 90 day, and 12 week. And so just the threes, and those you can look at the inside of the range for all three of that 12 week, 90 day, 3 month, and see where the meat of that range is going to be over the next 75, 80 days, whatever it is that we have left through the end of the March 30th, 31st quarter, and get an idea of where the meat of that move might be. So 4,800 could be the high of this market, and we're pretty close to it. Think about that for a yearly high, perhaps, maybe. You just do your own due diligence and whatever strategy that you want to employ. Okay, so I want to show you the VIX, and then we'll look at one more chart. So the VIX, I've got um, the VIX is now practically 24/7. So I've got the London session, with the VIX starting at 1:15 a.m. and then the US session in yellow, um, and a daily on this screen. And so the Globex, the nighttime, is in purple and white, and then the yellow is the RTH session. So you can see when it's inside the Globex RTH together, you're just going to be, that's your low vol going nowhere kind of stuff. And when you start breaking the ones, where does it go? One, two, three. It's just the same as everything else. This is the VIX. And these are that was a daily three right here. So if you break out of your ranges, so here we gapped open above the daily three. And here we're going to the tail one, tail two, tail three. And here you can see that they had their risks sitting on tail four. They weren't going to let them touch it. They sent it back down. And here it went right back to that daily three. So you can see the precision of these levels tied to these higher institutional algos where they're trading in and out of these ranges pretty much every day. And it's the same. You can go back in time when you get this on your chart. You have to pay for the CBOT data, CBOE rather, CBOE data plan to get the VIX and SPX data, but it is so well worth it. I highly recommend it. Here is the VIX on a daily weekly screen. So I've got trade days in solid and calendar days and dashes. So the 7 days are dashes, and the weekly number of days in the session are in white. And so algos trade to both. So you can see it went from the 7 day ones to the weekly ones, sort of ping ponged up and down in there. Then the 7 day or the weekly one broke higher, and so and then it came back to the daily threes. So they stay inside these ranges all the time, the daily, weekly, the VIX. So when you get this on your chart and you go back and start, going back through these prior trade sessions, you'll, really start opening your eyes. SPX, it's the same thing with the bell curve. Here's a daily with an RTH, or this is just daily because it's an RTH session based only. Um, and you can see that they trade very well to the Jats PT 123s. Here on Friday, it went up, right up to the RTA or the daily three, and then came down to the daily one. I need to add this. So you will be happy to put these on your chart as well. Here's the weekly and 7 day and daily for the SPX. And it can really, help you when you're looking at your open interest levels and your deltas and your open interest straddles, and put that in context of your historical volatility and your knowledge. You know that when you break a one, you're probably going short, right? It broke the 7 day one, came down to the weekly one, bounced between the weekly one, 7 day one. See that? And then it broke, went down to the lower daily one, back up to the daily three, and then back down to the weekly one down here. And there was a two. This two was sitting right underneath it, acted as support. Hard to see it, but there it is right there. The level shifted overnight, and so my levels are dynamic. It was up a little bit higher on Friday. So at the end of the day closed, it shifted lower, which may give you a little heads up. The distribution is still shifting lower. Yep, dynamic levels, they change. So here's an interesting screenshot for you. This is the VIX with our number of days in the calculations. So I start with a 7 day, or 7 period rather, 14 period, a 21 period, 30, 60, and 90. I didn't go all the way up, the complete moneyness vol term structure. But this is so intuitive and instructive. You can see how the volatility has just been flatlined, um, completely flatlined. We went down to zero 0.5. Let me maximize this so we can see it. There's point 0.5. So it tagged point 0.5 and bounced. And now we're in the spaghetti bowl of the 14, 21, 30. Here's your 60/90 up here. And you can see that the 7 period just broke the red. I think that's 21. Yep, 21. And the green is 14. And the white is 7. So, and then we're coming down to the purple is 30. The orange is 60. And the magenta is 90. So we've broken through the 30/60. So we're moving up with the volatility and it's pointing straight up. And there's a divergence if I've ever seen one. That is a volatility divergence. So you had a chance to buy cheap puts and it's just about over. Because once this starts going, like right here, you see there was your 5 dips. It never got, below 5 very much. Let me see. Put this at point 0.4. It has not touched 4. Done. Okay, right there. Did not touch 4 either. So 4 is, or that's a 5. That's a 5. 5 and 4 is very low. I mean, we were years, decades low. Look at that. Still didn't even touch it. You see what I'm saying? This is very cheap, low vol that we've been in, and it's artificial as hell. So once it starts rising, it's gonna, take off, and it can get, high fast. Look at that. That's COVID. So I was pointing this out to people that it's really nice to be able to have your own volatility indicator and so that we can measure it. And so when you subscribe to this on NinjaTrader, you can sit here and understand, what your 54321 is, right? And what that means, especially when you're trading volatility. You would be able to trade to the level that the institutions are looking at and know whether you're going long or short because they spike and then they revert to the mean. And so where is the mean? It's what I just showed you. It's that 60/90, right? The purple orange. So the fast lines are below it. Vol's collapsing. Fast lines break above it. Your vol is rising. And that's where you need your hedges, right? When it's flat, like right here in April, it went up right to the level and pulled back. Do you see that? Started collapsing again. Here it was rising. That's your hedge place. That's your Momo trade. If you're a volatility trader, you can be trading long vol, and short vol. Now, right here in December, it went long, but we went long in the market. We were below the 30/60. So that long vol was not short. When you're above the 30/60 and you're long, you're probably short. You see what I'm saying? Okay. So this is very, very helpful And Jats PT can help you with your analysis of this. And then, like I said, knowing whether your slope is short or long. Very, very helpful if you know what I mean. So I guess we could look at NASDAQ real quick, run through the chart. Don't want to leave my everybody's a NASDAQ trader. And next week in Skype, I'm going to add, I mean, in Substack, we have a training class next week, by the way, but a Skype training. But in Substack, I'm going to be adding the Aussie Japan forex pair and the Euro pound pair. Euro pound. If y'all want to see any other levels or markets, let me know. I'll be glad to try to add them. But let me put this on NQ and just take a look real quick. Okay, so here's the NQ, and you can see that in past price relative to these historical volatility standard deviation levels, here are your lower threes that price bounced off of. Here was a 2 that held support, came up to the threes, that upper 3 held resistance, 3 held resistance, came into the ones, broke this 1, and so here was your big breakout, and it ran from this 90-day 1 to the 2 to the 90-day 3, and then up to your 30 day 3. So from your 90-day to your 30 days. So that's one thing a customer had asked me, how can you have a monthly on top of a quarterly? I'm like, very easily. The monthly is faster. So you can have a new month above it. So if they're, if they're, um, trading alpha, the institutions, they know where to go, right? You don't have to give them an invitation. And then here was your outside risk on the 60 day. Hang on one second, I'm just freezing up. All right, so coming over here, here was your sell the rip. It got above the 60-day one, got above the, or was that a 30-day one? But it broke back under. So there's your cross recross, cross recross, and that is a pivot. Cross recross, and it crossed through a 3 as well. So here is, that prior volume cluster, and then your 2. The 2 is acting, the quarterly 2 is acting as the mean of these monthlies, 30 and 60 day. And then if the market comes down for that SPX level, then you want to be aware of where your 30, 60, 90-day ones are, likewise for the NQ. So we've got, 15, 346.50, 512.50, and 694.75. And then our threes are down here. And with this final long one, 90-day one. Or is that a 60-day one? Sorry. Oh, it is a 90. It's a 90. Yep. Okay, so just be aware of, what the opportunities are and trade intraday um, doing these levels. Again, your spreads, the same for the NQ as it is for the ES. Mainly these weekly spreads work a lot, right? For them selling premium. your 7-day and weekly threes. And then if that breaks, you need to look for your monthly and 30-day threes. And I put that inside of a 60-day three. So here was a 60-day three breakout to the monthly three. So a 60-day broke out to the monthly and then back in. Came down to the 7-day, back up to the um, 30-day three, and then that 30-day three held. Came down to the monthly three. Do you see how this works? And then back up and inside these weeklies. So just having a knowledge of where your, threes are located in conjunction to each other. If you want to be like the dealer and sell premium at these locations, right? And collect passive income. When you do this, you can put it in a Roth IRA account. You're trading equity indexes, the ES, the NQ. You have favorable tax treatment. You can use your, leverage better, I think, than SPX. And you have more access to the market as far as trading hours. And a lot of benefits for trading the ES futures and options on ES. And the passive income, like I said, it's, capital gains, 60% uh, capital gain, 40% ordinary income, or 40% capital gain, 40, 60, whatever that is. That, the 60% is the long-term capital tax rate, and the 40% is the short-term tax rate. So you're actually able to save money on your taxes by trading these instruments. And they're the most highly liquid instruments in the world. So there is a lot to be said by having the standard deviation support resistance levels on your chart. As the the professor from the New York School of Finance said, Jeff Ogden, the higher term institutional traders are using this, the big banks. Here is a quarterly level, so you can see it came down to the quarterly one, broke the quarterly one, came back and tested it, broke out, has come back in. Monthly, a great, chart to put up to do your top down review every day. Have it on your chart, NinjaTrader. Come in and build these distributions. Know where you are on the weekly, daily. So you can break these down, like I said, between the 5-day, 7-day, trade day ranges, and come up with some great intraday distributions for your weekly um, trading spreads, 1, 2, 3 months. So instead of it being 30, 60, 90, this is calendar days in the month. And also a good distribution to look at. And then here's your quarterly threes for the NQ. And you can see that we're just now breaking out of the top quarterly three, coming back inside. So if you want to fib where the middle is, and see where the higher time frame might be trying to get, to go to the middle of these ranges, you can certainly do that. So this is 13218. 0.75, and the top is, can't see, 1806.725. There we go. So 15,694, 594, 15,594, 52. That could be the locations they're trying to send this to. I mean, once you get used to what how they work, if it's not expanding range, if it's contracting, it could be, that higher volatility short trade to the middle, reversion to the mean trade on the higher time frame. So you could come up with a daily trade plan, however you trade, whether you're hedging or directionally long or short. We got you covered. And in fact, on an intraday time frame, before I let you go, a lot of you are just short term traders, um, which I also am. So let me put this back on a minute chart. I want to show you a couple of things. I gotta fix this template. So here's your opening range. Sometimes you don't get a full breakout. Here I got the signals to go down, but it went right into A1. Looks like a daily one blocked it. Here was a better opening range breakout. Or you can set this up with a trend filter and try to trade long or short with your volatility indicator. I wouldn't have traded that. But if you're an RTH trader, you basically want to try to set up intraday and trade, accordingly to your strategy. If you're trying to go long vol, you can set it up so that you're going long with the slope. So see here, it's setting up short with long slope on the PT2. So I'm going to give you a quick bloodhound lesson. You can put the Jats PT2 as a slope solver on the chart. And I will show you how to set these up in training. So you're just putting the PT2 indicator in the slope solver and use your function nodes, your long short modifier. And if you want to go long vol only and you want to go short, you can set your long short modifier. Sorry, hang on one second, my graphics card. Here we go. Set your difference to difference mode long short. And I don't want to see any longs, I just want to see shorts. So we're going to enable short true and enable long false. And so when we put the PT2 slope of Jats in, anytime the slope is long, we're going to generate a short signal. So if I restore this, All right, so you can see we're going long, long slope. I'm getting a short signal. And if I want to put in a bar direction now with it or momentum, I have my own momentum calculation. I'll put momentum because I want to go with the direction of the wind behind my back. And then I'll put a bar direction. Oops. So right there is long slope short. That fast, that easy. You've got a plan if you were inclined to go short to set it up so that you're going with the market now. I have my own volatility indicator. I don't like to take short trades in long volatility. So I can add my super trend. This is the Jats super trend. I have my own blend, but you can use hairy fat tails, or you can use um, the super trend from the NinjaTrader platform. So you can block your long vol. And now you know when you get a signal that, here, hang on a second, I've got one more. There we go. So now I have blocked my long vol, and I know that these signals are all long vol, long range, going short with my super trend and bar direction and momentum because I've set the math up to do it. Um, so very, very fast, very simple. It would take you probably 6 hours or 7 hours to set that up in C sharp. And we did it in less than 5 minutes. All right. So that is why I'm using Bloodhound and recommend that you pay attention to, you know, giving yourself an opportunity to go short when the ball is short and when the range is expanding. Increase the odds of your edge if you're doing short-term directional trading. Okay, guys, that's all I have for you. Thank you so much. Pick up the Substack subscription or pick up the indicator on NinjaTrader. Thank you. Bye bye.